We will have a quick presentation from the chair of the next session, Mr. Nikos Kavalis, Managing Director, Singapore Metals Focus, and also launch of 2023 Gold Focus. Then we would have the price outlook session as a discussion session that would follow. Before I invite Mr. Nikos Kavalis, a brief introduction. He's a Managing Director, Singapore. He's a founding partner of Metals Focus. He has got over 20 years of experience as a metals analyst, strategist with GFMS and Royal Bank of Scotland. With this introduction, right now he is the Managing Director, Singapore Metals Focus. I hand over the session to Mr. Nikos Kavalis and request him to launch 2023 Metal Focus, Gold Focus. A round of applause for Mr. Nikos Kavalis, please.
Thank you for the intro, Vatsa. Hi, everyone. Thanks for staying all the way till the last session of the conference. Right, I'm Nikos Kavalis from Metals Focus, and I'll keep it very brief. I'll give you a brief overview of the key findings of our annual report on the gold market, the Gold Focus, which we're just launching today. And then also the next couple of days in various locations around the world. Before I do any of this, I would just like to take a moment to thank the sponsors of this report. We give this report out for free to the world, and we can only do this because of the sponsorship of all these great companies that have been supporting us over the years, particularly Valcambi, who has been the front cover sponsor since day one of this product, but also all these other guys. Quite a few of them are in this conference. In fact, we can't thank them enough for their support. Right. So I'll start with a quick overview of the physical market last year and this year. Let's start with mine production. Global production rose by around 1% last year, mainly because of China's recovery after some disruptions that it had in Shandong province related to safety stoppages in 2021. That was the main reason why we had the increases here, and it was a historically high level. If we quickly look at production costs, I don't need to tell anyone about the energy crisis and the inflation that the world has faced over the last 12 months, and mining companies faced similar pressures. And these were added to already challenging conditions as a result of disrupted supply chains, hangover from the, return to normality after COVID, after the 2 years of the pandemic. So costs rose across the board for miners, and this came against the backdrop of prices on average pretty much being stable between 2021 and 2022. Naturally that meant that miners' margins suffered some pressure last year. Having said this, it was still a pretty good time to be a gold miner in 2022. Only about, I think from our costed production, only about 5 or 6% of operations were underwater on average, and that's only on an all-in sustaining cash cost basis. If we look at 2023, we see increases almost across the board for mining. The only exception being Asia, where Grasberg we expect is going to be down a bit, and China is going to go back into its secular gradual decline in mine production. All other areas, all other regions we see up year on year, and we do actually see an all-time record for global mine production for gold. These increases in mine production are the key driver for the increase in supply that we saw last year, and the rise in supply that we see, global gold supply that we see this year. And I think the interesting point, let's see if this works. No, it doesn't. The interesting point is that even though we have sky-high gold prices, in many cases even more aggressively higher gold prices in local currencies, it's interesting to note that Recycling last year grew by next to nothing, and again this year it's growing by a little more than next to nothing. It's quite interesting to see that, and I think this is a reflection of a couple of factors. One is, in some markets there's simply not enough near-market stock. The consumers just don't have enough jewelry to sell back to the market in enough old jewelry. This is particularly a problem in, well, not a problem, it's particularly the case in the Western markets. But the more interesting point is that across a number of, let's say, the more price elastic or the developing markets where historically we've seen big reactions to price gains, consumers there are just not comfortable selling their gold. They're looking at a world which is full of tail risks, fat tail risks, uncertainties in their local markets, in their local currencies, and they just don't want to sell their old gold. They want to keep hold of it. And this is actually a theme that we see even more strongly on the demand side, which we'll get to in a second. But yeah, this is definitely a very, let's say, from a fundamental standpoint, a very supportive development or fact. So let's turn to demand. Without a doubt, this most notable development last year on the demand side was the explosion in official sector net buying. We saw central banks buy more gold than, in fact, I actually sat down and dug out my old GFMS reports, and I could see that we haven't seen such a big figure since the records began in the late 40s. So I think it's safe to say that probably before 1948 there wouldn't have been any more buying than this, because there wasn't enough mine production to really buy these levels. So I think it's comfortable to say that this was an all-time high last year for central bank buying. De-dollarization, definitely a factor, or well, not definitely, because we haven't spoken to all of the guys that did the buying, but it seems to be a big factor. De-dollarization has been a theme in the market for a good couple of decades, but obviously with the events following the Russia's invasion of Ukraine and the sanctions that were placed on the Russian central bank, I think that focused the mind of reserve managers around the world, and gold was very much. It's an obvious choice to avoid this happening to you if things go bad in the future. We see a big drop this year in percentage terms, but if you look at the actual numbers, you can see that historically it's still a large figure. It's just that last year's number was so big that it was impossible to sustain. Jewelry consumption, one thing that, why is this not working? There we go. Jewelry consumption, look, one thing that's very clear is that we've comfortably moved beyond the post-pandemic recovery phase. For 2023, it's a bit of a mixed bag. We see some increases in East Asia. China is coming out of its pandemic controls, so naturally you have an increase. India is a bit more price elastic, so the higher price is putting some pressure for it. But I think if we go beyond trying to sort of say it's up 1, 2, or whatever percent, the really big thing here to notice is that even though gold prices are up significantly compared to last year, we're seeing jewelry consumption, which traditionally is a price elastic component, sustain pretty high, historically high levels, and that's definitely a very bullish or very positive signal that we see in the market. Similar for physical investment, we're seeing sustained historically high levels, and keep in mind that this is in spite of, if you look at the blue bit at the bottom, this is in spite of very dramatic drops in Europe due to the euro price having rallied. We've seen heavy selling there, but in spite of this headwind, physical investment demand is still very strong. Those of you who are involved in the space, you know that it's been a once in a generation couple of years that we've seen where demand has been extremely high and premiums have been extremely high. So it's been quite an impressive time, and driven by all the obvious reasons why investors' attention is shifting to gold. So let's now move to prices. Even though we see very strong appetite by official sector, retail investors, even some institutional investors who have a more medium, long-term horizon. The truth is that price direction tends to be fueled by institutional investor activity with a more short-term view, and this is why we've had, last year we saw the price come under immense pressure as professional investors reacted to the changing landscape on the US macroeconomic policy side. And what I've tried to do here is I've tried to plot, we try to create our own gauge of short-term interest rate expectations for the US. So it's very simple. All we did, we took current effective rate and we took the difference between that and the implied effective rate a year later using CME futures or CBOT futures, whatever you want to call them. And as you can see, obviously there's no pair of perfect correlation, but they've tended to move quite well with each other. And this is why we had pressure last year and strength in the first few months of this year. Now, unfortunately for our industry and those of us who do better when the gold price is doing well, we're not sure things will remain rosy for the second half of the year. If anything, we think that interest rate expectations will, at the moment, there's an expectation for 50 basis points of cuts. In the second half of the year, we are not convinced this will happen. The reason why we're not convinced this will happen is we just don't see a reason why the Fed would. Inflation is at its lowest level it has been since the swinging 60s. Sorry, not inflation, unemployment is the lowest it's been since the swinging 60s. And US inflation remains sticky, particularly if you look at the core gauge which the Fed tends to look at. It's done nothing for the last few months. Sure, CPI has been falling, but a lot of that is because of energy prices, pretty much unrelated to what monetary policy does. So, we think that chances are that we'll stick to, once we have another rate rise potentially in the next couple of months, or maybe this month, we'll just stay there for a while, and eventually the market will adjust to that new reality, and this is why we see gold coming under some pressure. But do keep in mind that this is some pressure, but we're still sticking to historically high levels, precisely because we think retail investment interest will reignite as soon as the price drops another 5–10% from current levels. The physical market will go crazy. You won't be able to find enough gold to ship to the Eastern markets, the Asian markets. So we are, let's say, cautious or let's say slightly bearish, but in the grand scheme of things, these are still very good prices, and on an annual average basis, we expect an all-time high for 2023. So this is it. I managed to keep it to around 10 minutes as I promised Albert. So I'll pass it back to Vatsa.
Please stay on here.
No, I'm staying on here. Oh, sorry, I forgot to say, there's a bunch of reports at the sort of...
Yeah.
Oh yeah, that's me. There's a bunch of reports. Oh, you will? Okay.
Thank you. Yeah, I take this opportunity on behalf of the organizer to thank Metals Focus for choosing APPMC platform to share this Gold Focus findings, and also some copies of this Gold Focus is there at the registration counter. I'm sure many of you would be interested. Please take your copy. Thank you so much, Nikos, and may I request you to kindly... With this background, we will go into the discussion part of this price outlook panel. For a session 6 price outlook panel, we have 3 very distinguished panelists. As I read out, may I request each one of you to come and take your seats. Mr. Bart Melek from 3D Securities, Mr. Bruce Ikemizu from Japan Bullion Market Association, and Mr. Nicholas Frappell from ABC Bullion. A round of applause for 3 of our very distinguished panelists. As they settle down, a brief introduction about each one of them. Mr. Bart Melek is a global head of commodities market strategy at TD Securities. a leading investment bank and financial services provider that offer advisory and capital market services. In his role, Bart contributes to the firm's strategic view by providing commentary on commodity markets and how they relate to the sectoral and economic outlook. Bart is an experienced strategist with demonstrated history of working in financial services industry, having 20 years plus experience in analyzing global precious markets, base metals, energy, and financial markets, as well as North American and global economies. Our next speaker, Mr. Bruce Ikemizu, joined the bullion market in 1987 and has had the opportunity to work with some of the finest companies, starting with Sumitomo Corporation, Credit Suisse, Mitsui and Company, Standard Bank, which later got renamed as ICBC Standard Bank, up until 2019. Bruce had been in the Japanese precious metal markets directly involved in trading and sales for the interbank or wholesale market up until 2019, when he established the Japan Bullion Market Association, JBMA. Currently at JBMA, he examines the market somewhat indirectly from an advisor's and analyst point of view. Our third speaker, Mr. Nicholas Frappell, is a global head institutional market ABC Refinery. Nicholas Frappell is the global head of institutional market for ABC Refinery, responsible for international precious metals market sales and commodity finance. As an experienced precious metals spot and swap trader with experience of developing business in Europe and Asia, prior to working in Sydney, Nick worked in London, Tokyo, Singapore, and Hong Kong. He is the chair of the LBMA membership committee and chair of the Gold Forum of the Minerals Council of Australia. With this introduction to our lovely speakers, I hand over the session back to Mr. Nikos Kavalis.
Thank you again. So before I start with individual questions to each of you, I just want to ask one for everyone. I've looked at your forecasts and your expectations, and all of you are bullish, which is quite different from the view I've just presented. So could I ask you to spend, I don't know, like a couple of minutes running through why you're bullish and why we're wrong?
I'm quite happy to tell you, Nikos, why you're wrong. I usually am. It's as an analyst, it makes me happy when I'm right and the rest of the world is incorrect. I don't know what it is, but maybe a personality disorder. But we enjoy it. Key reason here is I ultimately believe that the Federal Reserve will pivot into a much more accommodative monetary policy stance. TD Securities thinks that is happening towards the end of the year. You might ask, why do we think the market improves ahead of that? Well, it's typically forward-looking. So one, we think real interest rates on the short end of the yield curve will move down as soon as the economy slows down. I've argued that with the Federal Reserve's dual mandate, they will focus on the lower end of income distribution and cater policy to help the very poorest members of society. Right now, inflation inflicts the most damage on that group. Once things slows down and inflation is somewhat under control, they will pivot to help that group as well. And at the same time, we don't believe that they're going to be overly aggressive in trying to reach their 2% target. That means real rates will be conducive to significantly higher prices. We're looking towards $2,100 by year end or so. And we're also, agreeing with your point, we're going to see very robust physical demand, particularly from the official sector.
Thank you. Well, I would look at the market more longer term views. I mean, you just touched on the de-dollarization. I think that trend is really kind of continuing, will be a continuing trend. I mean, central bank buying, because of this West versus BRICS plus confrontation, and U.S. weaponization of the dollar is really pushing the other countries to go away from U.S. dollar to gold. And this trend, I think, will continue. This multipolarity of this world is totally different from what we have lived. I mean, what I have lived this past 60 years. It's dollar is everything, dollar is the king. But now, for Chinese, for Russians, for Indians, it is totally different world. So I think we should not take it for granted that dollar will be the main asset of the world as a total. And the other thing I'm bullish on gold, the factor is that increasing U.S. public debt. They just extend its debt limit from $31 trillion. I mean, until they just abolished it until to 25 January, and that we are already, getting closer to $32 trillion now. I mean, America's U.S. Public debt, and this is surely a very big element for coming inflation. I think by 2025, 2 years from now, we're going to see a serious inflation because the financing of the U.S. government issuing the debt. So that is basically a very strong, bullish factor for the gold. So I think, because of those points, especially the de-dollarization you mentioned, is really a very bullish factor. So probably metals focus the same. If you look at a long-term point of view, I think it will go up above 2,000, and as 2,100 probably at the end is the same as him. Yes.
Bruce. Look, I'm broadly bullish for much of the reasons that have been well rehearsed now with concerns over systemic risk and some of the banking issues in the States and potentially elsewhere. I also think that although I'm with Nikos in terms of the interest rate outlook, I think that the real rate outlook is probably one that's slightly lower, and that will tend to favor gold. I also think that official sector demand will continue to underpin. Looking at things in the here and now, also the trend, although the gold price has had some sort of challenges, we're literally, in the last 2 weeks since we moved off the recent highs, it's actually held all the important levels that it needs to hold. And as far as it continues to do that, and by important levels, I mean like the 100-day moving average, base of the daily Ichimoku cloud, so on and so forth, that is keeping it within the upward trend in the medium and the long-term timeframes. However, where I think gold faces a challenge, and this fits perhaps more into the sort of more bearish view, is in the next post the debt ceiling agreement, there's likely to be a significant liquidity drain coming from the Fed as they issue a significant amount of paper. Now, that liquidity drain will affect all asset markets, including gold. It maps quite well with gold. And if we do move below the recent lows and say the 100-day moving average, then I think that opens the way for gold to move down to the low 1800s quite easily. And that's kind of consistent with, I think, one of your outlooks. So that's going to be the big test for gold in the next, I suppose, 6 to 8 weeks. Looking through and past that, I do think that the picture for gold in terms of real rates and fears over systemic risk and debt and so on support a bullish outlook. And sorry, if I can just grab the microphone back. Obviously, everyone knows that 2070, roughly that sort of level, we've pretty much formed a triple top round there. If we get through there, I imagine there'll be initial run of short covering, but I think, 2100, that's very close to the previous highs. I think it's got scope to go much further than that over the longer term. You're more likely to have the freedom to move up to sort of the 2300 level rather than just another $50.
Thanks, Bruce. Look, I'm broadly bullish for gold in terms of real rates and fears over systemic risk and debt and so on. I think
Thank you all. Bart, and actually Bruce as well, because interestingly, Bruce touched on it already, but actually in your Crucible article, I got a sneak peek, thank you for that. You touched on the point that investors are increasingly worried about the US's structural imbalances, and I think you mainly were thinking fiscal imbalances rather than current account ones there. I think that's a very interesting point because I was looking at the US is just about to enter the club of top 10 most highly indebted countries in terms of debt to GDP. Now look, the US is special, right? I mean, it's the de facto reserve currency. They can get away with borrowing a lot more than anyone else would before alarm bells start ringing. But 130% is 130%. Where do you see this going? Could things change? Could trust in US sovereigns dissipate? And how does gold play a role there?
Well, it is very true. The U.S. deficit is getting quite large, I think, by any metric. In relative terms and in absolute terms, you're going to have to issue a lot of paper to fund it, and it's going to get increasingly more expensive, particularly now that Treasury rates have gone exponentially higher from just a year and a half ago. I don't believe the U.S. dollar's position as a reserve currency is threatened for the foreseeable future. It might be a little soiled, but still probably the cleanest shirt in the hamper. If not the US dollar, then what? The euro, probably not. It's still a leader in technology. It's still a growth leader. Quite often ignored fact, the US ratio of the global economy, it's been maintained for quite a long time, and that's despite of the fact that emerging markets have surged higher. The U.S. has kept pace in relative terms, and that's a fact that really not known. So I don't believe that the U.S. is defaulting anytime soon. However, with acts of Congress, recently passing a massive stimulus bill, and a protectionist bill to a great extent, the Inflation Reduction Act, a bit of an oxymoron. I'm not sure how it reduces inflation by introducing trillions of dollars. What we're seeing is a continuation of spending way beyond the economy's ability to get the revenue, making necessary the issuance of paper at a pretty rapid clip. Now, I don't think the U.S. dollar, is in danger. But I do think that there will be a combination of the Federal Reserve probably not targeting the 2% target with policy, and there will be a creeping reduction in purchasing power, as opposed to the U.S., buckling down and forcing tax increases. Tax increases are not very popular. No politician likes to tax people, but everybody wants to spend. And I think, that goes from the Republicans to the Democrats. There hasn't been a fundamental difference. So what does that mean? I think over time, if you are a reserve bank, a central bank, let's call it, People's Bank of China for no better example, with $3.18 trillion, and vast majority of your reserves is in the US dollar. Not only are you worried about geopolitics potentially being sanctions if some sort of tensions arise, but you've got this asset that is increasingly used less. You're using other currencies. Trade patterns have changed, so you might want less in your reserve of that. And you're also worried that your purchasing power over time will erode. It's not going to happen in a year or two. I don't believe there's going to be a crash. Remember, the U.S. has the U.S. Federal Reserve that can buy unlimited amount of paper at will. We've seen trillions being purchased. But I think if I'm holding $1 trillion in U.S. dollars, I may be worried that that $1 trillion isn't going to buy as much as it is today in 10 years' time, and I would want to diversify more my portfolio for later, and ultimately gold seems to be the better alternative because there are no other assets that would solve the problem for me. If there's a sanction imposed on me, euros two. Certainly, dollars would be number one. And do I want to hold any other currency? Well, once I invest in it, I might have the same problem. And gold is no one's liability. There's no counterparty risk. And once I have my bar, I have my bar. Perhaps I just have to make sure it's in my domicile as opposed to the Bank of England or something. But I think that's going to be quite supportive.
Thanks, Bart, and thank you very much for that colloquialism. I'm going to keep that. The cleanest shirt in the hamper. I love that. I would like to switch to the physical market. We are in Singapore. It's a physical hub. Nick, if you could help us a bit. Look, I just want to get your thoughts on prices versus physical demand. Look, we all saw that as gold, rocketed through 2000, demand virtually drained in a number of physical markets. Some of it has come back as the price has dropped. So could you tell us a bit more about what you've seen? How sharply or how badly did it disappear when we hit those highs? Where you saw weakness and strength? And maybe also touch on what your magic sort of thresholds are in your mind for when we will see, the floodgates opening and on the upside, demand completely dying.
Yeah, sure. I think in terms of where physical demand comes in now, and when I say physical, really talking about kilobar demand in Asia, I think the price levels we're looking at here and below certainly favor kilobar demand. And if you look back over where we were when the gold price went beyond 2000, then for sure two things happened. Kilobar demand declined, but also there was obviously a powerful urge for people to send sort of scrap into the market and so on. And that obviously you have to fight with that when you're trying to sell fresh gold. But what's notable in the over $2,000 level this year was that we certainly saw some large bar demand and quite good large bar demand. And it seemed to be price insensitive. So whoever was, buying that from the banks that we were selling to, the suggestion is that it's large bars and it's price insensitive, so it looks like the official sector. And that meant that sort of from the overall totality of physical demand in the sort of 2000 plus wasn't quite as dented as much as I'd have expected, this time last year perhaps, or this time 2 years ago, when you'd really, really expect a lot more gold to head towards the terminal market. The other thing we've seen lately is a little more resumption of demand from markets that have been a bit quieter because they've had really, really high domestic currency costs for gold. And what that implies to me is that they've begun to work through some of the gold that kind of perhaps came out as secondary or was sold back from the domestic market. We're just beginning to see that come back at these levels, 1950s, 60s, 40s, definitely it's back, yeah.
And sorry to put you on the spot here, but what's the price trigger or threshold going down that you really see, demand going stratospheric again? So how far do we have to drop to see, obviously not a 2013 kind of situation, but last year kind of situation where, you really can't find enough investment product and kilobar product to service, and you have nice premiums, et cetera, et cetera.
I think in terms of, if you're just looking at straightforward cast bar demand, if you really want to see a genuine pickup in demand, I think then, sort of 1850s and that kind of level, I think you would see a lot more coming through. It's kind of a difficult level to pick, but sort of I think initially if there was a bit of a sharp drop, then some of the physical buyers might step back and just see, okay, where is this going before committing? But I think, 1880, 1850s, you'd definitely expect to see a good rush of demand.
Bruce, just wanted to get your thoughts on something that I've noticed in the last maybe year and a half. Historically, that's traditionally Japanese investors, always buy low, always sell high, right? If the price goes up by 10%, it's a disinvestment. Drops 10%, it's a positive investment.
You know very well about Japanese market,
Yes.
investment market. Well, I think Japanese investors are really genius because they always buy the bottom and sells at the top. But yes, that's right. I mean, that's a trend we really have seen this past 20, 30 years. And this is pretty much the same, but things that are changing, I see, is that the generation of investors, gold investors in Japan, it used to be very old people. When I do the seminars, education seminars about precious metals, it's always very old guys, like my father or like my mother, very old lady, old gentleman, I would say like 90% of the audience. But lately, last year, this year, when we do those kind of seminars, there are lots of younger people. Now younger generation is more than older generation. They had really real interest in gold. That is, we are, in yen term, gold is historical high, 8,800 yen, today. We had 8,900 yen in early part of May, and that is historical high. Even those historical highs, we had expected huge disholding of the metals from individual holders. But now, when I talk to those retail shops people, they say pretty much balanced, selling and buying. So those younger generation of physical gold investors, they don't care about the past prices. Doesn't matter for them. There were times when it was like 1,000 yen per gram. Now it's 9 times more, but they don't care about it. And as I formed this JBMA, Japan Bullion Market Association, 3 years ago, and what we are trying to do is to educate the investors about gold, platinum, silver, palladium. Not really much palladium, but gold, platinum for sure, and silver. And what we are seeing is really the change of the sentiment. What I really emphasize on those seminars is that to have the money in the bank account to go risk-free is not really true. It's not really right. If you have the yen in your bank account, and if you think it is risk-free, it's not totally wrong. It is totally wrong. And as we had like dollar yen 2 years ago, January was I think 115. Now we traded up to 150, and today is 140. So it's your money is really the worst. Purchasing power of your money is really decreasing, especially yen. So for those investors who really notice that kind of risk, it's best to have a gold in yen. Because gold is uptrend, and also yen is very downtrend. That makes gold and yen getting higher and higher. So now younger generation is really realizing the risk. And we are having a new, fresh interest into our market, so which is quite good, and it's very good chance for the industry. Gold and platinum also industry to go into those investors who only traded stocks or FX come into gold.
Thanks. I have quite a few more questions for you guys, but are there any questions from the floor? Please. And if you wouldn't mind introducing yourself.
Sure. I'm Chris Irwin. I'm from Bank Julius Baer. For any of you, typically investor demand has been a very strong driver of gold prices, both on the way down and on the way up. This year, we've noticed that ETFs have seen consistent redemptions, so basically falling at a pace while gold's been really rising. What do you think is causing this weakness in investor demand? Is it merely higher yields? Because gold's actually holding up quite well in terms of like outpacing treasury yield. And what do you think would cause investor demand to turn around? And also, is it becoming a less important driver of gold prices?
Well, it's been a very interesting year for gold. We had a macro and monetary environment that was really not conducive to high gold prices, and yet gold has outperformed pretty much all other major asset classes without exception. Bond yields moved higher quite sharply, almost across the board. It wasn't all uniform. So bonds didn't do well. Equities for a time were selling off, so that whole 60-40 portfolio didn't do well. Yet gold did well when the dollar was relatively firm and interest rates were rising. What gives is an interesting question. I think, one, we've seen unusually strong physical demand, and I think historically unique, that has offset the weakness in the financial markets. And, we track the CTA systematics. Over the last month or so, they turned around and were buying quite aggressively. Right now, I think at 20% maximum long positions. So those are the key factors that have been making this trend quite unique. And I'm quite sure there is also a speculative component here where we're looking at the Fed funds, Federal Reserve dots from the FOMC having just a massive difference between the futures and where the Fed is signaling, 2 years out or to 2024, we're talking about 110 basis points. And people were taking bets on that, I think all of us agree, even though I'm bullish gold, I think the next few months could be quite tricky because somebody is going to be wrong here. If the Fed stays hawkish for longer and we don't see that imminent pivot, we could see gold, past that 100-day resistance level here, and 1900 below is very possible. I think we rebound, but it's going to be a tricky situation, particularly if physical markets and the premiums in Asia and others don't hold up. So it remains to be seen if this is, next few months is $1,900 or $1,800.
Anything to add, Nick?
Yeah, I think one thing that's quite interesting looking at the managed money positioning is that you've seen long liquidation really from probably 2025 and above, and you've seen some further long liquidation since. But I'm pretty sure you're not seeing any material increase in shorts. So I think that tells you something about sentiment that the managed money sector isn't actively betting against gold at the moment. That they might do if the price broke below some of the levels we've talked about, but so far it's really been a long liquidation market rather than a shorting market.
The way we're positioned on the CFTC, and that's something we comment on every week, there is a case if the macro environment turns, there could be an awful lot of short covering which could really move through the technical points very quickly. When I say 2100 by year end, that's a quarterly average, but 2300 from a trading perspective I think is very much possible and in the cards.
Unesh.
Thanks for the inputs, everyone. Unesh Ripai from Wheaton Precious Metals. Trade data does indicate that we are in a recessionary environment, but when you look at the gold-silver ratio and where silver is tracking, and if your outlook for gold is quite bullish, where do you anticipate silver's role as a safe haven, and as the world enters into an environment where we potentially could have higher interest rates for a prolonged period of time?
I think Bruce has traded quite a lot of silver in his past, so maybe he has some views.
The LBMA had a questionnaire on the prices forecast this year, and my name was on it. I thought, because I made a strongest, most bullish silver price forecast. And I was, But I think you mentioned about gold-silver ratio. Above 85 to 90 is silver too cheap. And, I think it should be go down around 75 to 70. So in this ratio, I would rather buy silver and sell gold. Well, it's historically maybe I don't have to tell you, but it's like last 50 years, it is around 55 to 60 to 1, right? And then in the COVID days, it went down, it went up to 120 to 1. I told the investors in Japan, buy silver. This is ridiculous. Buy silver. And that was bottom. I was lucky that I was right. But I think, people, especially US and somewhat Japan as well, some people really love silver. And because silver is, unitary cheap, so if you think gold is going up, they would rather buy silver. And silver is kind of leveraged move. So if gold goes up 10%, silver goes 20% up, or vice versa. So I think those individual interests would support silver market. And above 85 to 1 is a very good point to entry to silver. This could be a answer.
Thanks, Bruce. Any more questions from the floor? No? I actually, if you don't mind, I'll add something to the silver point. Look, Unesh, in my mind, there are two big themes when it comes to silver and the price over the next few years. One is, regardless of whether we're entering a recessionary environment or a slow growth environment, the underlying fundamentals of silver look spectacular. It's no scenario that we've plotted has seen silver not have sizable deficits over the next 4 or 5 years. The second reality for silver is that there's, pardon my friends, shitloads of it around still. So it will take a bit of time for these deficits to eat into what's available, and during that period, I'm guessing silver will continue to trade as a high beta gold trade. But I would say that over time, we have to see this gold-silver ratio slowly but surely move down, because sooner or later its fundamentals will matter more and more and more. And I'm quite positive for the long-term outlook for the price.
I'll add a little bit on silver as well. We're looking at a fairly robust price relative today. We're looking at about $26 as an average for the quarter. And to Bruce's point here, the vol is 2 to 1. So if you like gold, you should like silver. Yes, I think over the next few months, particularly if the U.S. does go into recession as we predict, there will be some headwinds here. But in the end, we continue like Metals Focus. In fact, we're quite happy to leverage their research, do see yet another fairly robust deficit. And when we look at inventories of silver, particularly of the unallocated kind, that is eroding. And you can certainly, you can imagine a world in the next few years, if this continues, there isn't going to be that silver. So you're going to be feeding hand to mouth here. Recycling isn't enough, since 3/4 of it comes from secondary sources, and we track base metals, copper, zinc, lead. There isn't the investment there either. If you believe that the Western world is serious in moving to a full electrified economy where we are net zero based on the Paris Accord plan, I think silver has a beautiful future. Copper, silver, to me, are the essential metals for electrifying the world, something that has to happen and is not available. Those inventories, especially the unallocated, will move. And if we do see investors start buying ETF again, I'm not sure how we easily balance that market, particularly if lease rates drop lower and bullion banks are going to be unwilling to provide that to physical markets as much as they did.
Thanks, Bart. Nick, in your Crucible article, you raised a very interesting point that you don't I definitely don't see many people talk about in the gold market, that of what happens when Japanese monetary policy eventually changes. Could you expand a bit on that and share your thoughts on what this would mean? Well, first of all, if you would be prepared to give the Nick Frappell forecast for when this might happen. And second, and more importantly, what does this mean for gold when it happens? Because, this has been a constant for quite a number of years.
Yeah, unfortunately, you can't technically, you can't chart the attitudes of the BOJ, so it's a hard one. But look, I think talking about yield curve control, this is something, okay, firstly, in terms of what it is, it's a target for purchasing bonds to keep the Japanese money markets liquid and bond yields low. And effectively, the only difference is to QE, for those who aren't familiar, is that you're actually targeting a fixed yield as opposed to a fixed amount of sort of yen buying. Anyway, so that's what yield curve control is. And it's become harder to justify carrying on with that policy because gradually Japanese inflation is beginning to ramp up and labor costs are beginning to ramp up. And if that feeds into Japanese CPI and becomes a bit more self-fulfilling, then having this kind of 10-year yield target of JGBs at 10 basis points, whatever, it's not sustainable. Now, a couple of things. There was, I think, some talk about it happening around about now, but it hasn't. And the reason why, I think, is firstly because the BOJ, the new governor, Ueda, he doesn't want disruption on the very beginning of his term. And he's also been favored by some weaker sort of data in the CPI. So he's been able to put it off. I think he's also put it off, this is maybe a completely personal view, but he's also been able to put it off because he saw what happened with rising rates in America, with Silicon Valley Bank and a host of other banks, and the degree of disruption that took place there. And I think he's mindful of, firstly, not creating another problem on the kind of world scene, but he's also probably conscious of potential problems within the Japanese banking system and the life assurance system that might be revealed quite harshly if there was a sudden move upwards in rates. So he's got to sort of cautiously exit this policy. I think what will happen is you will see an exit and you'll see a steepening of the bond curve in Japan. And I'm going well outside of my remit here, but you'll see a steepening of the curve, and you'll see probably a recovery in the yen, and you might see some disruption and dislocation both in the JGB market itself, but also potentially within domestic banking. There is, and I don't want to misquote it because it's quite contentious, but if you look at the kind of BOJ's own website and where it talks about risks within the system, if there was a significant parallel shift in the Japanese bond market, it would wipe out a significant amount of equity in Japanese trust banks. So there is a vulnerability, and I think that sort of thing, I don't think you would get a parallel shift, by the way. I think that would be highly unlikely. I think you would get a steepening effect. But I think the point is that there's plenty of reasons to be cautious, and there's a tremendous need by the BOJ to signal very carefully that it will exit, so it's not building up a problem, but that it's going to tiptoe out of this situation, if that makes sense. It's worth saying, just as an analogy, or not an analogy, as one of the funny things about YCC, or yield curve control, is that actually the Bank of Japan owns more bonds in certain tranches than have been issued by the government. And the reason why is because some people have said, well, we'll actually short some of these bonds, and the BOJ has bought them, and then now so there's potential for some really nasty squeezes on the way out. But I hope that answers, that's my view. So when will it happen? I think probably earliest Q4, but I think this is a problem that, a can that would like to be kicked way down that road.
Right. Bruce, if I could pass it to you. Historically, the APPMC has been accused of not paying enough attention to PGMs, and I think this year we're making a strong point that we're not just a gold and a bit of silver hub, but we are striving to be an all precious metals hub. So I think it's important to cover them in the price outlook session. So, Bruce, could you tell us platinum, palladium, and if you are brave enough, rhodium?
Yeah, well, we're working for WPIC in Japan. We are helping their activities. So yeah, PGM is very important metal for us too. It used to be Japan is the biggest market. Now China, I have to admit, is the biggest market. But yes, about PGM price forecast, I simply say platinum I'm bullish because hydrogen society and South Africa electricity problem, and also palladium subsidized by platinum. And palladium, I'm very bearish because 80% of demand is coming from gasoline engine catalyst. And now, as you look at, 2 weeks ago I went to Hong Kong, and on the Hong Kong road, I would say 10 out of 1 car is the Tesla. I don't know why I don't see Tesla here, but in Hong Kong it's very electric. So that is I think we still need some time, but that is a trend. Then gasoline engine will be fading out of the market. Then 80% of palladium demand will go away, and that makes me very, very bearish on palladium. And so I think in 2 to 3 years, platinum, palladium again reverse the price relationship. Rhodium, I'm pretty much neutral in rhodium with this 4,000 to 6,000 price level. We started rhodium rally from 2019, mid 2019, from 4,000 to 30,000. $30,000 per ounce, and then we come back down to 6,000 now. I think, if you think about the production quantity, like 20 tons, something like that, less than 1/10 of platinum, and the usage is again catalyst for the car. I mean, in combustion cars. That is kind of. I feel it is balanced around this level. So probably I wouldn't I expect it to go down to 2,000, but probably could be 4,000 to 6,000 is probably the comfortable place for rhodium. Okay, it's about time.
Thanks. Actually, it looks like we have another 5 minutes. I think maybe they started the timer early, which is perfect because I want to ask something from all of you. So I wanted to get your thoughts. I guess it's loosely related to de-dollarization, but less from the point of view of, is the dollar going to become irrelevant, et cetera, et cetera. I wanted to get your thoughts on, we are increasingly seeing trade flows bypassing the dollar, and I wanted to get your thoughts on how, what's the future of this as far as gold is concerned. And this is obviously very important for Singapore as a hub and Asia, the various Asian hubs. Do you think, what's the trajectory with which the gold crosses, gold denominated in different currencies, become more and more important versus the traditional, you buy it in dollar and then figure out the FX as a side note?
I'm going to take a stab at it. Certainly, I think, if you look 10, 20 years ahead, it's going to become a bipolar world. And what I mean is, probably a US dollar hub and probably an RMB hub. What does that mean? Does that mean reserve currency status full blown? Probably not, but I think as these relationships grow and policies of bringing back production and supply chains back to North America, back to Europe, there's going to be a reaction in this part of the region where the links are going to be local and more robust. Of course, interlinks between those two spheres as well, but ultimately, we're probably developing a bipolar world where we're going to have more separations than we had, and I think that has been a political choice, particularly if we see these geopolitical tensions rise and economic policy in the U.S., which is increasingly becoming isolationist and, America first policy, not only with this part of the world and China broadly, but also with trading partners. So you can well imagine that some players might want to play in the U.S. sandbox and the Asian sandbox at the same time. And we could be developing different markets of influence where there is going to be almost de facto separation. And the good news is I think the banks are going to come in and merge the two as intermediaries, but I see that developing.
More money for you. That's good. Bruce or Nick or both?
Yeah, look, one thing that I really think about the de-dollarization conversation is that it's exaggerated. Not necessarily right here, but it is largely exaggerated in the media. There are issues around, so I'm going to try and bullet point this, but because of time, but there are issues around the weaponization of the dollar. I think that when we talk about institutions that want to buy gold because they are worried about sanctions and so on, that's actually a very small number of institutions because there can't be that many countries in the world that are really genuinely worried about being sanctioned by America. It's a small group of actors. I think the other thing is that the dollar fulfills very, very many functions and has done really since the sort of Bretton Woods and world and onwards. There are some very, very deep, important things that the dollar does in terms of absorbing the world's trade and financial imbalances, and there is no other currency or jurisdiction that can do that. So that's one very powerful thing in favor of the dollar. The other thing is as well is that global reserves have been growing a lot for a whole bunch of reasons, largely, for a lot of it is China's sort of mercantilism and so on. And that has grown world reserves beyond which perhaps the level where you need to hold X amount of dollars. So given all of that, a lot of what we're probably beginning to see is an element of diversification in central banks who say, we hold the dollars that we should hold, and beyond that, there's an implicit cost in holding dollars, so we should hold other things. And it's very natural, as Bart said, that gold should be one of those assets. But I don't think that's a negative thing. That's not a profoundly negative thing. That's coming out of the fact that 20 or 30 years ago, America was a much larger share of world trade. That's slightly diminishing, but that's coming for good reasons. That's because other countries have grown and taken a bigger share. So I don't know. So I think the discussion about de-dollarization, some of it comes from bad reasons, which is to do with sanctions and weaponization. But the really big picture is still it's a dollar world and kind of really ought to be.
Just put it this way. I think the gold is the only currency that both parties, West and BRICS Plus can appreciate. So that tells everything, I think. In this bipolar world, gold value is getting more and more important.
Thank you all. Thank you, all of you, for staying and attending this. And I will pass this back to Vatsa.
Thank you very much, Mr. Nikos Kavalis, and all the speakers, Mr. Bart, Melek, Mr. Bruce, and Mr. Nick Frappell. Thank you so much. May I request you to kindly, help us with a group photograph. We have just 15 to 20 minutes more, so please do stay back. We have interesting items coming. Thank you so much.